Hey everyone, welcome back to our channel, Investo Time. Today, we're diving into critical insights from Chris Vermeulen, founder and chief market strategist at thetechnicaltraders.com. If you're not paying attention to the gold and silver markets, now's the time to start. Let's get into it.
I believe we're in a new super cycle for gold. It's had a pause and we're having a run up as we get closer to a recession, to a financial crisis. People are moving into gold, very similar to what we saw over here. We had a new super cycle for gold. It consolidated for a couple of years and we saw money moving into gold just before we got into a recession and a financial crisis, which was the 2008 pullback. Gold pulled back 32% or 34%, and then it took off. So I believe gold has this little bit of upside back to 2650, 2750. And then we're probably going to hit this recession, some financial crisis, whatever blows up. And then we're probably going to see gold have some type of pullback. After that pullback, which I'm kind of hoping is next year, is when gold starts this next multi-year run up.
Gold recently peaked above $2,500 per ounce and is now trading at $2,445, driven by global tensions and economic instability, highlighting its enduring appeal as a safe haven asset. As the US dollar and bond yields ease from recent gains during Tuesday's European session, gold holds steady at around $2,400. Investors are now looking for clues on whether the United States will enter a recession and are closely watching for signals about the Federal Reserve's plans regarding interest rate cuts this year. Chris Vermeulen, founder and chief market strategist at thetechnicaltraders.com, predicts a short-term bullish trend for gold, with prices potentially reaching $2,650 to $2,750 per ounce, a 10 to 11% increase. However, he expects a pullback during an anticipated recession or financial crisis, possibly next year. Meanwhile, silver faced significant pressure early Monday, dropping to the critical $26.50 level, which has been a key point multiple times. The metal appears to be breaking through the 200-day exponential moving average. According to Vermeulen, silver is more volatile than gold and remains far from its all-time highs, but he maintains a long-term bullish outlook for the metal, expecting it to outperform gold percentage-wise. Data from FX Empire suggests a small bounce might occur following the sharp drop, though confidence in this bounce is uncertain, with a strong likelihood of breaking through the support area, advising caution for potential buyers. Before we dive deeper into Chris Vermeulen's expert analysis, please take a moment to like this video, subscribe to the channel, and turn on the notification bell for timely updates. Thank you, and enjoy the video.
I still really like gold. I think gold's going to 2650, 2750, which is more or less, up to here or somewhere up to here. So there's still some good upside potential percentage-wise from where it closed. There's still another 10%, 11%. To the upside, which is really just Fibonacci measured move. You have the run up, you got the pullback, and then the second half of that move. So I'm still bullish on gold when we look at it over the next several months. Now, the monthly chart, which you and I looked at last time we spoke, the monthly chart to me is when we step back as a long-term investor, where is gold going to be 5-10 years from now? I believe we're in a new super cycle for gold. It's had a pause and we're having a run up as we get closer to a recession, to a financial crisis. People are moving into gold, very similar to what we saw over here. We had a new super cycle for gold. It consolidated for a couple of years and we saw money moving into gold just before we got into a recession and a financial crisis, which was the 2008 pullback. Gold pulled back 32% or 34%, and then it took off. So I believe gold has this little bit of upside back to 2650, 2750, and then we're probably going to hit this recession, some financial crisis, whatever blows up, and then we're probably going to see gold have some type of pullback. And then after that pullback, which I'm kind of hoping is next year, is when gold starts this next multi-year run up. So short term, I'm bullish on gold. Long term, I don't think there's a huge rush to get in because I think it's going to be back at this pricing or a little bit lower, maybe a year from now, but that will be the last opportunity to pick up physical or miners. That's when miners should come to life, is somewhere over here. After we've had the financial reset, they should come screaming back to life. So depending on who you are, the type of investor you are, I like physical metals. I've got physical metals. I don't have any gold miners at this point, just because I think gold miners are going to be amazing 6, 8, 12 months from now, that's when they'll have an opportunity that could last years. Yeah, silver is much more volatile. Obviously, silver is nowhere near the highs, up around $49. This is the weekly chart. It's nowhere near the highs from just even a few weeks ago. It's actually still down 13%. Silver, I'm bullish on silver. Silver percentage wise, I think is going to do exceptionally well. It'll outperform gold in the long run, but gold is the global safe haven play. It's low volatility. People from everywhere buy it. It's kind of one of their first plays. Like, what do I do if I don't want bonds or stocks? They say, I'll get some gold. More aggressive traders move into silver. They move into miners. They have more potential, but they're a higher risk. If you're not going to make a ton of money, if there's not huge opportunity, it's probably a consistent high probability trade. Silver and miners are volatile. People get into them and they suffer forever until there's a super cycle, which we're still probably 6, 8, 12 months away from the next major leg up. Whereas gold is hitting new all-time highs, as you mentioned, James, and it's just consistent. If you want a low risk, high probability trade, you're not going to like make a fortune, consistently make money. Gold is that. That's why I love physical gold. I like charting gold, and silver will play catch up later, but you got to go through that roller coaster ride because it's a risky one, and you need the stars to align perfectly for gold and for silver and miners to like skyrocket.
U.S. stocks are tumbling due to concerns over a potential economic slowdown, and even the prospect of lower interest rates isn't boosting investor confidence. ASX-listed stocks are also feeling the impact of increased global market volatility, despite having recently hit record highs after a strong run-up through mid-July. The U.S. stock market is under significant selling pressure, with media reports filled with predictions of impending doom, which bearish commentators see as validation of their "the sky is about to fall" narrative. To put things in perspective, the S&P 500 peaked on July 16th at 5,669.7, marking a 25.8% gain over the past 12 months and a remarkable 45.4% rise from its October 2023 low. However, as of the close on Friday, August 2nd, it has fallen 10% from that peak. Chris Vermeulen provides insight into the current market conditions, noting that internal indicators, such as cycles, money flows, and momentum, suggest we are on the verge of a bear market phase. Whether this will be a minor downturn like in 2022 or a major financial reset similar to 2000 or 2008 remains uncertain. Vermeulen warns that the potential downside could range from 30% to 60%. Let's get back to the interview.
I've talked to a lot of advisors. They're all saying, get into bonds, get into bonds. Unfortunately, most of their clients are already in bonds and they've been holding them from, they're down 40% on them. But they're trying to tell people to shuffle in, which is a little bit concerning, but I'm not a fan when everybody's saying get into bonds. But if rates are going down, we should see bonds go up, and they are starting to firm up. And, we saw a lot of panic on Friday in the stock market with the VIX skyrocketing, stocks crashing, and we saw people move into bonds as I think what also helped fuel it's a defensive play. People are naturally want to move into bonds, even though they've been beat up on them. So it definitely had a big move. We saw TLT move 3%, which is huge for TLT. The other interesting play is actually the utility space. The utility space is giving some pretty interesting divergence, where if I was to compare the SP 500 in here, and if we just look at those two charts together, we're in this point where we saw this just before COVID, the COVID crash, which is we see utilities do exceptionally well. So the stock market topped out here. It's down about 5%, the SP 500. From that same time window, we've seen utilities, they have pushed up about 8%, but they're up about 6%. This is a huge divergence. The fact that the stock market is crashing and huge panic and people are moving into utilities, we saw almost this same type of thing happen just before the stock market fell off a cliff for COVID. And we see this over and over again, not to this extreme, but over the last several years, every time utilities perform really well, the indexes pull back a bit. The indexes usually will fall even more, and then utilities will fall with it. Right now, this is just a defensive play. When the stock market does potentially bounce over the next week or so, and it starts another down, if that's what it's going to do, utilities will get wiped out too. It's just a short-term play of people moving in. So there's this divergence here is a big warning flag that I think we're about to see a big pullback in the market. That the internals, the weekly chart, when I look at our weekly trend chart of the markets, we want to know when we are in a bullish environment. We also want to know when we're in a bearish environment. We are still in a bullish environment right now, but everything this week, based on the closing bar, because this is the weekly chart, is telling us we are like kind of like right here, or we are like right here. We're very, very close. Everything behind the scenes, cycles, money flows, momentum, all of that stuff is telling us we are like right on the cusp of starting another bear market phase. And the question is it just a small bear market like 2022, or is it, a stage for massive financial reset like 2000 and 2008, where we see the stock market potentially fall 30, 50, 60% or more? That's where we have to stand. But behind the scenes, this market has broken down on a weekly standpoint based on a big trend. It hasn't given us an exit signal yet for long-term investment capital, but we are darn close, a week or three away from potentially closing all long-term positions in equities, because we're going to go into a potentially year or two pullback, or a lot bigger than that.
Given the potential risks and uncertainties in the market, how are you adjusting your investment strategy to prepare for a possible significant bear market? Share your thoughts in the comments below. If this video resonates with you, join our community by subscribing to our channel and turning on notifications with the bell icon. Thank you for being part of our community.